Welcome back to FinScribble, everyone. Today, we are uncovering a hidden $12 trillion force that might already be controlling a massive chunk of your wealth without your knowledge. For decades, private equity was an exclusive playground reserved strictly for ultra-wealthy billionaires and secretive institutional titans. But if you take a close look at your 401k statement, your pension fund, or your life insurance policy today, you will likely find private equity lurking quietly in the background. It has even bought up thousands of local veterinary clinics, emergency rooms, and your neighborhood dentist's office. Wall Street firms have systematically shifted their focus from public markets to private buyouts, soaking up capital from everyday working professionals. The big question is no longer whether you are invested in private equity, but rather how much exposure you actually have, what risks you are unknowingly taking, and whether this massive financial transformation works in your favor. To really understand this shift, we need to compare how public stocks and private equity actually operate. Buying public stock is like buying a single brick in a massive skyscraper. You own a tiny fraction, you can buy or sell instantly on an open exchange, and company managers do not know who you are. Private equity takes the exact opposite approach, operating like a whole house flipper. Instead of buying fractional shares, a PE firm buys the entire company outright, using heavy leverage and private institutional cash. They replace executive leadership, overhaul daily operations, trim expenses, and boost profitability over 5 to 7 years. Once restructured, the firm sells the business to another buyer or takes it public for a major payout. This hands-on, aggressive transformation is fundamentally different from passive stock ownership. So, how did a high-stakes strategy like this end up inside your retirement fund? How exactly did private equity sneak into ordinary retirement portfolios without most investors noticing? Historically, private equity funds required millions of dollars in upfront capital, completely locking out regular investors. However, as institutional asset managers sought higher yield, regulators began clearing paths for private investments to enter target date retirement funds, pension plans, and expanded annuity products. Today, when you contribute to a standard 401k target date fund, a small slice of your contribution can automatically get funneled into private equity vehicles. Furthermore, major financial firms have launched specialized exchange-traded funds and interval funds that wrap private buyout assets into retail-friendly packages. On top of that, life insurance companies are backing their policies with private debt and equity assets to boost declared yields. Without ever filling out a specialized private fund subscription document, your retirement savings are actively participating in private corporate buyouts. It is an invisible expansion that has completely redrawn modern asset allocation. Now, why would pension managers and 401k providers embrace private equity in the first place? The core selling point is known as the illiquidity premium. Because private equity investments lock up capital for 7 to 10 years without daily market trading, investors historically demanded higher annual returns to compensate for that lockup. Over past decades, private equity frequently outperformed public benchmarks like the S&P 500 by 2 to 4 percentage points. But that locked-up capital comes with major trade-offs that every worker must understand. You cannot simply click sell on a bad market day if you need emergency cash. Furthermore, private equity management structures often charge steep management and performance fees, typically 2% annually plus 20% of profits. If returns slow down, those heavy fees eat directly into your hard-earned retirement nest egg. Balancing high return potential against fee drag and total illiquidity is the central debate in modern portfolio management. Looking at the freshest Q1 2026 market intelligence, this trend is expanding faster than ever before. Recent data from PwC reveals that global private equity assets under management have surpassed $12 trillion, driven largely by institutional inflows from pension systems. Meanwhile, market reports from Fortune Business Insights show a massive push toward retail democratization, with individual investor allocations expected to grow over 12% annually through 2030. To solve the locked money problem, major funds are rapidly expanding secondary markets, allowing investors to trade private fund shares before official liquidation. However, PwC analysts warn that higher interest rates have made debt-fueled corporate buyouts much more expensive to pull off. As a result, mega funds are shifting strategies toward operational improvements rather than pure financial engineering. The market is evolving rapidly, making it vital to monitor how these trends affect your retirement growth. Knowing where institutional capital is moving gives you a huge advantage as an individual saver. So what should you actually do with this knowledge today? First, log into your 401k or IRA brokerage dashboard and review the prospectus of your target date or multi-asset funds. Pay close attention to fee-expense ratios, management terms, and redemption policies. Look specifically under the asset allocation section for underlying alternative investments, private market exposure, or private credit holdings. If you are decades away from retirement, a small allocation to private equity can potentially boost your long-term growth, despite the illiquidity lockup. However, if you are approaching retirement or need flexible cash access, excessive exposure to illiquid assets can create unnecessary financial strain. Do not panic and exit your funds blindly, but ensure your overall risk profile aligns with your investment timeline. Private equity is neither inherently good nor bad, but understanding its role lets you take full control of your financial destiny. Keep asking smart questions, stay informed, and make your money work harder for you. As always, appreciate you hanging out today. See you in the next one.